Hello, everyone, and welcome to SCORE Fairfield County's live webinar on tax advice for small businesses in the time of COVID-19. I'm Mike Clem, a business mentor here at SCORE Fairfield County, and I'll be your host today. Our presenters today are Bryan Pennington and Tony Wimpers. More on Bryan and Tony in just a minute. But first, some brief information on SCORE. SCORE is a nonprofit organization with over 300 chapters around the country and more than 11,000 volunteers that provide free business counseling to small business owners and entrepreneurs. And SCORE is also part of the Small Business Administration. SCORE Fairfield County has over 110 volunteers with a wide range of industry, process, and subject matter expertise. We offer three primary value-added services to small business owners. First, we offer one-on-one counseling, which in this current environment is all remote. It could be by email, telephone, or video. Secondly, we offer educational workshops and webinars, over 150 per year. All of those are also in a virtual environment as we're doing today via webinar. And finally, we offer an extensive resources on our website, including a network of subject matter experts at your disposal. Let me first give you some useful information about today's webinar. If you have a question, please use the chat window at any time during the presentation. It's located on the lower part of your screen. Our webinar will end at 1 p.m. to respect your time. This session is being recorded, and the link to the recording will be available at fairfieldcounty.score.org within the next couple of days. And now let me give you some information on our speaker, Bryan, and I'm going to ask Bryan then to introduce Tony. So let me start with Bryan. Bryan Pennington is the Director of Audit and Accounting at Venman Co. Bryan has over 13 years of experience in public accounting and specializes in providing financial statements and tax services to privately held businesses and nonprofit organizations. Bryan is a licensed CPA in Connecticut and California and is a member of the American Institute of Certified Public Accountants. I'll now turn it over to Bryan. Bryan, it's all yours.
Okay, thank you very much, Michael. Let me know if you guys have any problems hearing me and I'll speak up or lean a little closer to my microphone here. But like Mike said, I'm Bryan Pennington. I'm a CPA with Venman Co. We're a 20-person firm located in Shelton, Connecticut. We have clients primarily in Fairfield and New Haven counties here, but we have clients that go down to New York and Massachusetts as well. We work like Mike said, we work a lot with privately held businesses and nonprofit organizations. That's really kind of my niche that I work a lot with. And I'll let Tony here give a little background about himself. Tony, do you want to go ahead and give yourself a little plug about what your background is and kind of what your expertise is?
Of course. Thank you, Bryan. So yeah, as you guys know, my name is Tony Wimpers, and I'm a CPA, a tax manager at Venman Co. I have 10 plus years of experience helping small businesses and individuals with tax planning and tax preparation in a whole variety of industries, construction, real estate, service-based businesses, manufacturing, and I look forward to teaching you all some interesting things today. Thank you, Bryan.
Great, thank you. And then we'll go ahead and jump right in here. What I'd like to I'll start with is say that the purpose of the whole presentation is to provide you all with information and address any questions or concerns that you guys have. So really, we put together some information that we think's applicable for 2020 and what might be useful for your business, but this is really meant to be educational and beneficial for you all. So any questions are welcome. I know Mike mentioned that to just type them into the chat, and yeah, and then we could kind of address all the questions at the end. There isn't a whole lot of content here, so I don't expect us to be talking for more than 20-30 minutes. So really, I want there to be hopefully a lot of questions that we could maybe address and discuss towards the end of the webinar. Because really the goal is to provide you with information that's going to help your business. So that's really the goal here. So that's kind of what the presentation is in mind, is I really kind of tried to leave some time on the end for questions. So if we don't have any questions, it'll be a short presentation. So I encourage any questions that you have. Okay, and then just to jump in here, obviously 2020 was, a lot has happened this year, right? We have COVID-19 and the impacts on businesses being closed or being required to work remotely. There's changes in business practices, what the demands of consumers are, right? Because everyone's business has been impacted by COVID-19 and everything that 2020 has to offer this year. So as I'm sure you guys have been dealing with it the past several months, is adjusting and updating your business model to make sure that you are best serving your customer needs and making sure that your business is going to remain viable and prosperous in the future. So these are things that we're going to be covering today, is COVID-19 and the impacts on business. Then we're going to kind of jump into the CARES Act and the PPP loan program a little bit, the loan forgiveness, and how it all kind of flows through on your taxes. And then we'll also get into like the election outcome and what potential changes there could be down the road. So that's all kind of our planned coverage of the webinar today, and then we can get into any questions. But like I said, there's been a lot of disruption and change this year, right? With your business activities, which you've been working tirelessly throughout the year to kind of change and adapt. So then as we get towards the end of the year, we have to start thinking, okay, what are the tax implications of a lot of these changes? For the better or worse, businesses have changed. Did your revenues go up? Did your revenues go down? It just really depends on what service that you're providing. And if, for a lot of people, they saw their revenues go down significantly. And then what efforts were you making to address that? Were you incurring additional expenses to kind of maybe adapt your business model? Maybe you have some employees that started working remotely. So then there's tax implications for all this stuff, and all things that need to be considered when you're kind of putting together your tax information and entering it to make sure that you're not missing out, obviously, on any tax deductions that you want to be taking, and also not reporting stuff incorrectly, because your operations most likely changed significantly from 2019 to 2020. So it almost requires a full, fresh look at how your tax revenues and expenses are being reported to make sure it's being done accurately. So that's kind of the first and foremost thing. And then, so what can you do, I guess, so for those people that had big losses this year, what approach can you take then on your taxes kind of for 2020 and going forward? The one big thing is for 2020, you're allowed to have losses up to $500,000 and deduct that. But you also have the ability to go back 5 years and offset that against taxable income that you paid in previous years. So that's one big way to kind of recoup some costs and recoup some money from the government, is to, if you have a lot of losses this year but in previous years you were paying taxes to the government, you could then submit for reimbursement for those taxes for losses that you incur this year. So that's a big thing that you should be considering. If you had a big loss this year and you had revenues in previous years, it's definitely something to look into and figure out a way to recoup some of those tax payments that you made in previous years. And then a lot of it's related to, okay, so in 2020, maybe you had a big decrease in revenues, but what are you expecting for 2021? And kind of projecting that. If you're expecting your business to kind of rebound and have a big successful year in 2021, and that's what you're budgeting for, you may want to consider trying to shift some of that revenue or into 2020, or postpone some of those year-end expenses into 2021 to help plan for your 2021 tax implications. What you don't want to do is have all these big losses in 2020, and then 2021 comes, and all of a sudden now you're having to pay taxes again because if there's ways to kind of push some revenue into 2020, that will maybe decrease your tax liability in 2021. So it's all things to consider. Another thing that's also a great idea, if you happen to have any Roth IRAs, this would be a great year to maybe convert those to traditional IRAs, and take the tax hit on those this year. That might be able to offset against some of those losses that you're having on your business this year. It's a good way to kind of balance that out, because eventually, if you have a, I think I might have said that backwards. If you have a traditional IRA, you might want to convert it to a Roth. Sorry about that. Because at some point you're going to have to pay tax on your IRAs when you start receiving distributions. But if you have a big loss this year, this might be the year to maybe to incur those taxes and convert it to a Roth IRA, because then you're going to shift those assets into a vehicle that's going to allow you to have earnings on a retirement vehicle that you will no longer have to pay tax on in the future if it's converted. So that's one key recommendation we make to a lot of our clients. Let's see, I think I covered a big piece of the changes to consider for 2020. I'm going to let Tony jump in here and kind of cover some additional thoughts that he had on the subject, and to cover a couple things that he was planning on covering today. So Tony, you want to jump in?
Thanks, Brian. So just some other things to consider for 2020 as we draw to a close to the end of what most people consider to be a pretty terrible year. We all say, 2021 will hopefully be much better. But some things to think about as you guys are doing tax planning and thinking about this stuff. Back a couple of years ago, when the big Tax Cuts and Jobs Act got passed, President Trump signed into law at the end of 2017, there was actually a legislative glitch that occurred, and I'll have to explain that. For several years prior, if you made a renovation to a commercial building, you could take what was called bonus depreciation if it was to the interior of the building and met some other requirements. And bonus depreciation basically allowed you to deduct 50% of the cost of whatever the renovations were. For example, you installed some new non-weight-bearing walls, you redid the plumbing, you redid the electrical, and it cost you $100,000. That you would have qualified to deduct 50%, $50,000 of that cost in the year that the job was completed. And it was a huge win for taxpayers at the time. Now, that was assuming that the depreciable life of those assets were less than 20 years, or usually it was 15-year property. Now, when the Tax Cuts and Jobs Act was passed, the way it was written, these improvements no longer fit into the 15-year life, and thus you got stuck with 39-year life depreciation, which was not a win for a lot of taxpayers. So basically what that says is if you put $100,000 worth of equipment or worth of improvements into a property, you can only deduct 1/39th of that cost over the next 39 years, and which is like just over 2.5% a year. So it's definitely not favorable. And many commentators, and I think even certain politicians, were saying that just was a glitch when the bill was written. And so when the CARES Act came out back in March, they fixed the glitch, and which was a huge win for everybody, because not only under the Tax Cuts and Jobs Act, the bonus depreciation went to 100%. Now, any renovations that you had placed in service going back to 2018 qualified. So all that stuff went from 39 year down to 15 year. And then, so if you did qualifying improvements to your property in 2018, 2019, or 2020, you could benefit by writing 100% of it off in the first year. Now, a lot of people didn't do that in 2018 and 2019 because the law just hadn't been passed yet. So what you can do in 2020, you can actually file what's called a change in accounting method form. It's the IRS form 3115, and that actually allows you to catch up the depreciation to what it should have been. So for example, you know, if you place something in service in 2019, for example, or 2018, and it cost $100,000, you know, and you only took 2.5% in depreciation deductions in those years, you can basically, what the form 3115 does is it actually catches up the depreciation and allows you to take that deduction that you should have gotten in the past on your 2020 tax return. So it's definitely worth looking at your depreciation schedules to see if that's a possibility, because my slide says it's money on the table if you don't take a look at that. So that's something definitely to consider. Actually, I see that we have a question here from Dawn. What if your improvements were to your home office or all of it? That's an interesting question, you know, because technically it's only for commercial property. You know, of course, though, if you do place in service your home office and you're taking depreciation on that, that's something I can take a look at, you know. And Dawn, I'd be happy to explore that with you. If you'd like to send me an email after, I can get you an answer on that. So thank you for that question. Also, something to consider too, is something I was going to bring up, is the change in accounting methods in general. Now, these change in accounting methods are really valuable for taxpayers, because basically, if your method of accounting doesn't work as it is, you can actually change it if it yields a more favorable result. And the one change that I've seen a lot of money get refunded to taxpayers over is the change from accrual to cash basis. Now, for financial statement purposes, you know, you have to be on the GAAP accrual basis accounting, method of accounting. But for tax purposes, in the eyes of the IRS, you can be under any method that is what's considered to be permissible. So generally speaking, if you look at your accounts receivable, and if you see that the accounts receivable is a lot more than your accounts payable year over year, then that means that you are generally, in any given year, paying tax on sales that you're not expecting to collect until the next year. So really, you're getting taxed on, I wouldn't call it phantom income, because you eventually collect it, but income, you're paying tax on money that you have not yet received. And generally speaking, you can switch from accrual to cash basis if your average gross receipts for the last 3 years were less than 26 million, which I think for most small businesses, I don't think you can call yourself a small business if you're over. It could be a big win. And it doesn't matter whether you have inventory or not. That used to be a thing. There's still a couple of exceptions, but the general rule is that you can be cash basis. And I saw a client last year. It created $1 million loss for them because they never collected their receivables until after the end of the year. And it was just a huge win for them. But that is also done on a Form 3115. And you know, if you guys have any questions on this, if you are looking to possibly do something like this that could save you a lot of money, please reach out to us. You know, we would be happy to take a look. And actually, I see another question here from Michael. Are you limited to only one change in accounting method over the life of the company? And the answer to that is no. Though I think if you can change a multitude of things. It doesn't have to be just one change over the life of the company. I know in cases, you can change from accrual to cash, and then down the road, if you could actually probably change back to cash to accrual. Though there is a practical aspect to it that the IRS may look askance if you change it every year, so it has to be done within reason. But for sure that's not limited. I see another question here. Sole proprietor here wondering how to line item the PPP so my Schedule C is accurate. Well, we're going to get to PPP in just a second, but I would say that generally, if you're well, actually, I'll get to the next slide and I can answer that question for you guys. And I didn't miss Brandon's question. Brandon, I'm getting to you. So hold on one second. So Brian, could you forward to the next slide? Okay. So so if you have been the recipient of a PPP loan from the SBA, generally, so the CARES Act, when it came out in March, basically said that it's not, the loan proceeds are not taxable, assuming that they were spent on the right things, like, just for payroll, or, if it was for utilities or rent, etc. But in May, the IRS issued a notice saying that all the expenses would be disallowed if the loan was forgiven. And that's pretty consistent with how such expenses have been treated in the past. For example, generally the IRS doesn't allow deductions for that are directly linked to tax-exempt income. For example, to put it in a more practical, a better example, if you have tax-exempt interest income, from municipal bonds that you have, like on, as part of your investment portfolio, generally the expenses prior to Tax Cuts and Jobs Act were not allowed because they were directly linked to a tax-exempt source. And that appears to be the approach that they have taken here. So for Lynn, to answer your question, basically the expense, you wouldn't have to actually, you wouldn't include the loan proceeds in income. It is taxable income, but what we're doing is we're treating it as taxable income through a reduction of your expenses. So in the example, just to make the example simple, if all you have is, all you spent the PPP money on was payroll, that would be, and say you got $100,000 in loan that ended up getting forgiven, you would reduce your total payroll expense that you would report on your Schedule C by that $100,000 that you received. And if any of it was for rent, you would reduce rent expense, etc. So, yeah. And Brandon, as far as the PPP loan, yeah, it will be considered income. It's not income, but it's taxable through the reduction of the expenses, as I mentioned. And they're fighting this on Capitol Hill right now. They're hoping that these expenses will be deductible. It seems kind of backwards that the government would hand out money and then claw it back through taxes, but that does happen. But we shall see on that. There's a lot being decided right now. So as I mentioned, expenses incurred are currently not deductible. But there is an exception, though. It's just an interesting one. For the self-employed replacement income, like for example, you are a sole proprietor and you have no employees, to make the example simple, anything that would be considered to be replacement income, which I think is generally your net income, that there is no reduction of expenses for that, and thus those expenses are still fully deductible. Although everything else, you may have payroll, rent, etc., a deduction would not be allowed. So that's an interesting exception. So basically, for Schedule C people, where none of the loan proceeds are getting allocated to any of those above categories, it is sort of essentially free money in that respect, which is an interesting twist. And it's not consistent across all entity types. So if you are an LLC with one member, or you're a sole proprietor, or you're operating as a partnership with a couple other people, that is a big win. But if you're a corporation, that just doesn't exist, because you wouldn't be considered to be a self-employed person. So that basically takes care of the CARES Act from that standpoint. And now I'd like to turn it over to Bryan, who has some further things for you.
Tony, were you going to touch on the Connecticut paid leave? You want to touch on that now?
Yeah, I can touch on that now. Sure. I was going to bring that up at the end, but that's okay. So just so you all know, there was recently a new law that came into existence that basically creates a government mandated Connecticut paid FMLA program. And so the taxes paid by employees as a payroll deduction, and everybody is mandated to contribute 0.5% of their salary, whatever that ends up being, up to the Social Security threshold, which I believe this year is 142,000 or thereabouts. And that's something that I think a lot of people aren't aware of yet, especially small business owners, because they're going to be the ones that are going to have to pay in and remit those funds to Connecticut, I believe every pay period or every month. And the main thing to do now is to register. You go to the Connecticut Paid FMLA website, and essentially, if there's any workers who, for example, they have a child, or there's an illness or something happens, when they go out on FMLA, they'll actually be paid for it, I believe up to 12 weeks. And but the main thing to do now is to go on the website and to get registered for that, because as of January 1st of 2021, all employers will be mandated to withhold that 0.5% from everybody's all their employees' wages. So that's just something for you guys to be aware of. There are a couple of exceptions to that. If you have for example, if you're a government agency, that's one exception. If you're a sole proprietor, you can actually get away with not doing it. Sole proprietor means that you're not incorporated. You can be an LLC, and you could be a partnership too, actually, if you got one or more partners. However, if you are an S corporation and you are actually drawing, or a regular corporation, and you're actually drawing a W-2 salary from that, you too will be subject to it. Unfortunately, even if, in my parents' example, they own an S corporation and it's just the two of them, they each draw, W-2 wages every year, they are subject to it as well. So definitely, I would say definitely go to the website to find more information on it. And if you guys have any specific questions, I'd be happy to answer them. So Let's see. So I see a couple questions here from Douglas. Does the employer have to contribute to this new program? The employer does not. It's mainly it's just funded through the employees. That is my understanding. And the next question, Gregory, if you are an S corp and contribute to a KEO plan, is there anything like a Roth? I think that would depend on the circumstances. Gregory, feel free to email me after, and we can discuss the specific circumstances. You know, I'd be happy to get an answer to you on that. And Monica, suggestion for good real estate business CPAs in New York City, affordable for new businesses. You know, we'd be happy to handle that. You know, we deal with a lot of real estate in this office. We do some very large real estate, we do small real estate, and everything in between. So yeah, of course, and I can post the email address right here for you guys. And that is, I'm twenfriss@venmanllc.com. And actually, you'll see, actually, our last slide has the contact information as well, just so that you all have it. So that basically covers what I had. But if there's anything, I guess I turn it now back to Bryan, who can cover more for you guys.
Right, yeah, and Tony, just to let you know, when you just posted your email, but it was just to me privately, so you might want to post it again to the group.
Oh, thank you.
But and it will be on the last slide as well when we get to it. You'll have both mine and Tony's information. And I guess I just want to kind of conclude a couple things on the PPP program, so that Tony didn't touch on. One was the loan forgiveness for a lot of people likely is going to be happening in 2021. I'm guessing for the majority of you, the loan forgiveness hasn't officially happened yet, or it might be starting for some people. But if loan forgiveness doesn't happen until 2021, it still is considered a 2020 event essentially. So all those expenses that you incurred in 2020 that were used for loan forgiveness, even if the loan didn't get forgiven until 2021, you still are not allowed to take that deduction on the expenses in 2020. So that just
correct. It's based on the expectation that it'll be forgiven. And assuming you have that expectation, then yeah, then you can't deduct those expenses.
Yep, exactly. I think that was it there. I guess a couple other questions came in. Let's see. Here's Kara's had a question. I took in more in this year than last year with minimal deductions without travel or meals. Any tips to maximize tax deductions or credits? Anything new to this year I may be missing? Well, I mean, obviously there's going to be, if you had incurred any costs related to COVID, if you had to outfit your office with COVID supplies, that's obviously a new expense you'll have this year. For the most part, your travel and meals, I mean, all that stuff's going to be pretty much the same. It's pretty much the same law as last year. So kind of the same guidance you followed in 2019 for meals and travel. It will be the same guidance, whether for what meals are still deductible or non-deductible this year. Right, Tony, anything you have to add there? What other deductions people might be missing out on? I think everything's pretty much the same as 2019, right?
Yeah, Bryan, I think pretty much everything is the same. One thing I like to tell people just on an individual level, you know, is to maximize your non-cash contributions. For example, if there's any clothing you can give to Goodwill or anything like that, and that's a big win because that's one of the few deductions you get without actually having pay any cash to receive it. So it can be a win-win there. Also, you know, if you're thinking about purchasing any large equipment in 2021, you may want to consider that before the end of the year as well, so you get the deduction this year. And if it's this year, you know, you can, and if you have a loss that you can carry back to a previous year, you can get the benefit pretty quickly.
Yep. And there's another question about here about what about the impact of the EIDL grant? I'm guessing that's like the small $5,000 grant that some of you all received. I believe that's tax-free. Is that your thoughts as well, Tony?
Yeah, I believe so. Yeah, it'll follow the same concept as the PPP loans. I mean, I haven't seen anything to the contrary yet, and I think the IRS is going to issue more guidance, once the year is over. But that is my understanding currently, that they'll be treated the same way.
Yeah. Okay, and then Don here had a question. Are you only able to use PPP from the date you received the loan, or can you deduct previous costs? Well, I wasn't going to get too far into the loan forgiveness and what's an allowable cost, because that's a whole other seminar on its own. But generally, there's a covered period for the PPP loan. So when you received your loan, that's the trigger date essentially of when your covered period starts, or in or around that date. And then your expenses then go from that date for the next 20 odd weeks. I forget the exact number. So it has to be within that time period. So most likely your expenses were incurred in 2020. But so hopefully that answers your question. But no, you cannot go back to before your PPP loan was received. You cannot go and use those costs for your PPP loan forgiveness. Okay, one other question here from Diane. I realize your topic is for businesses, but wonder if you could help. I'm a consultant and work as a W-2 because I'm out of work a lot and need to collect unemployment. Is there anything more I can deduct on my Schedule A as I worked remotely this year? Or do I need to do a Schedule C? Yeah, if you're a W-2, that was really eliminated a couple of years back when through the Tax Cuts and Jobs Act that was put into place a couple of years back. The ability to use your home office or mileage that used to be done several years back was basically done away with. So for those W-2 workers that maybe have a home office, there's really not much you could deduct on your Schedule A. If you have a Schedule C and you have some sort of in a business, then yes, then you can do a lot of that stuff. But no, to answer your question, Diane, no, it's not really anything you can do on your Schedule A to deduct any of that. If you're a W-2 employee, there's really not much you can take on the side of deductions to help you out, aside from your standard mortgage interest, property tax, or your contributions, either cash or non-cash. So a question here from Brandon. What if I'm an S Corp and received a PPP loan? It is just me and my wife. We received the funds but didn't pay ourselves in the covered period. Can it still be forgiven? Yes, I believe that falls under the replacement income. So that's another question. That's more of a question related to the loan forgiveness piece. But from what you're saying, it sounds like when you get to that point where for your loan, where you get to the forgiveness part, you should be able to apply for the replacement income up to the max, up to whatever you applied for. Up to there's a threshold. You can't exceed like 20,000, I believe it is, something around that. But that would be, I would think, just based on my limited, just from your question, that you'd be able to get forgiveness on that replacement income, even though you didn't have any expenses. So I think that answers your question there, Brandon. If no other questions, I'll kind of go over to the last kind of couple slides that we were going to cover here. The next one was, okay, now that we kind of covered, okay, what all happened in 2020, what were the effects of the CARES Act and kind of some of the other government programs that were going under. So what changes, one last change that happened in 2020 was we had an election, right? And then there's a new president-elect, Joe Biden, and he has his own kind of tax plan that he's going to try and implement going into the new year and starting in 2021. And the thought is that he's going to try and push a lot of changes kind of from day one. So what I did was kind of bullet pointed kind of some of the key changes to expect into 2021. Obviously, a lot of this is still, none of this has been even proposed yet. This is just from his kind of his website, what his proposal was. I mean, obviously this is all just kind of pie in the sky right now. But it gives you kind of a general idea, just kind of a tax planning perspective, what to expect over the next couple of years, kind of for your tax planning and business planning purposes. So this is all just for that. None of this has happened yet, and a lot of it, how much of his planning that can go into effect, a lot of it's going to be based on the Senate. If the Republicans still control the Senate, then a lot of his changes might not go through because a lot of it depends on what happens in the Senate, and then what happens once he actually gets into office. So these were just, we felt like it was worthwhile just to share what some of the potential changes are, just for your informational purposes. And like I said, none of this is written in stone or even in the works yet, but these were his proposed changes. The biggest one was he plans on implementing a Social Security tax for those who have wages over $400,000. He's also planning on increasing the tax rate for the top income tax bracket and increasing the capital gains tax rate from 20 to 39.6% for income over $1 million. The new cap on itemized deductions, that kind of reinstitutes the old cap, not allowing you to itemize over a certain threshold of your income. These are kind of just general things for your consideration. Here are a few more here. Obviously, one of the big things that hurt us Connecticut residents with the Tax Cuts and Jobs Act was the $10,000 cap for the state and local tax for on your Schedule A. So that really hurt a lot of Connecticut residents because we're a high income tax state. So a lot of those taxes that you pay out of your wages to the state or on your property tax, before 2017, you were able to deduct all this on your personal tax return. And then once that went into effect, it was all capped at $10,000, which significantly hurt a large portion of Connecticut residents. But under Joe Biden's plan, he would be proposing to get rid of that cap. So that's maybe a potential bonus that might be coming our way, but we'll see. A new thing that happened a couple of years back was this new qualified business income deduction, and that was for a lot of you sole. And this was a big deduction that was added for a lot of you small business owners. The ability to deduct 20% of your revenues as a deduction on your personal tax return. But under Joe Biden's plan, it would either change or eliminate that. It's really unclear what his plan will be with that, but the idea is that it will most likely change in the near future, but obviously we don't know how. And the last couple changes is related to estate taxes and estate tax planning, and just to be aware that there would likely be changes under the new president elect's plan. I think that was all of our content here for today. I think that was everything that we wanted to cover. Any other kind of final questions? I think we were kind of covering them as we were going through. Tony, did you have any last final parting words? I think that was all that I had on the docket for today. Any other questions from the audience?
Brian, this is Mike. You talked about potential tax changes coming up. I think there is some talk anyway about perhaps another PPP loan coming down. Do you have any guesses about that in your crystal ball?
Yeah, I mean, that's what all small business owners and what really I think the whole general public's hoping for another round of something. What it's going to be is, I mean, it's anyone's guess at this point. The one thought is that there'll be another round of PPP, just kind of like the last one. Really, it's anyone's guess. And then it's will they wait until after the Joe Biden goes into office? Will they try and push some changes through beforehand? How will that affect unemployment? Will there be extended unemployment benefits out there? I mean, really, we're talking about, I think the biggest kind of question out there is what will happen with just the existing PPP loans. There's been a lot of talk about just fully forgiving all of the loans under a certain like $50,000 or allowing those expenses to be deducted even if they were used as part of the loan forgiveness. So there's just a lot of questions out there, and it's really as anyone's guess. So what the best you could do is just kind of go based on what you know now and plan conservatively. So when you're planning your 2020 taxes, assume that those expenses that you incurred for your PPP loan you won't be able to use it as a deduction on your tax return. So then if the Congress happens to propose something that allows it, then it's a bonus for you. But all you can do is plan based on kind of the information that we have, and what will happen in the future is anyone's guess, really.
Okay, anything people should be doing in terms of keeping track of particular expenses, whatever, so they're ready to take advantage of something like a second round of PPP?
Yeah, it's just making sure you have all your documentation in order. It's making sure you're entering your financial information from your bank statements into however you're keeping your records, either on a monthly basis, at least. It was what I would expect business owners to be doing every month. If at the very bare minimum, each month when you get your bank statement, I would expect you to be kind of updating your financial records. If you use QuickBooks, which I imagine a good chunk of you are, making sure that you're entering information into your QuickBooks on a monthly basis and not trying to do it all at once at the end of the year, because that's what the bank's going to be asking for. If there's a PPP loan, they're going to want to see your balance sheet. They're going to want to see your profit and loss statement, just like the last round. So my guess is that would work very similarly.
Okay, good. Question from Michael in the chatter. You mentioned you would discuss required financial documentation for EIDL loans. Could you let us know what that might be?
Maybe we were talking about the PPP loans. The EIDL loans there's really not much I don't think you need on that. It's typically, if we're talking about the grant piece of it, it's okay, you got $5,000 grant, but that they call a loan, but it's free money. You got that grant, that money is yours. You don't have to really do anything else on that. If there's an additional loan that you're required to repay on top of that, yeah, for the loan piece, then what you have to do is just repay the loan when the terms come due. Yeah, you have to just repay the loan when it comes due. It's not nothing really you have to do on a tax side aside from documentation. Well, it's just, there's not really much you'll need for the tax return. It's really, okay, whatever your loan balance is, that's what you report on your tax return as the loan. And then any payments you make on it will just be applied against the loan. There's really not much else you'll need to do, really, as far as documentation, aside from just tracking when you're making your payments and it decreasing your loan balance.
Okay, and Brandon has another question. How will SBA EIDL loan work for your taxes if you take one this year versus taking it next year?
I don't think it really would have much of an impact for your taxes, because with an EIDL loan, that's a loan. It's not free income. So essentially, it's whenever you incur your expenses, that's when you report it on your tax return. It's not the same thing as the PPP loan, and how that loan forgiveness works, because the EIDL loan isn't going to be forgiven. That you have to repay that. So the expenses that you pay through the EIDL loan, you don't need to. You'll still be deducting that on your tax return. So you'll just keep your standard document. If that's the question related to documentation, you'll be keeping your standard expense documentation, any payroll records that you paid, any expenses that you paid for rent. It's just kind of keeping just kind of standard accounting documentation. It's nothing above and beyond that. Does that answer everyone's questions? Did I miss anything there?
Okay, I think so. Well, we'll see if Michael comes back in the chat, but let me make another, maybe I'm going to ask you just to confirm something, make sure I heard it, because when I think, Tony, you were talking about the Connecticut FMLA program here where employee contributes 0.5% of their salary up to 140,000 or so beginning next year. I believe you said, I think it's important because a lot of sole proprietors have no employees. I think you said that if you were a sole proprietor with no employees, you would not have to contribute the 0.5%. Did I hear that right?
That's correct. Yep.
Excellent.
Yeah, for that, it's optional, because if you have no employees, then, I guess the theory is that you wouldn't have to contribute. So, or even if you do, I think you'd be exempt under that. But if you're any other form of business, then I think you would.
Okay, excellent. Hey, another point you guys made is interesting that the self-employed replacement income program, that is tax-free, whereas the PPP loan is technically not tax-free. At least it's currently.
Yeah, correct. So really it's, if you have not gotten to the point of your loan forgiveness application, you might want to try and maximize that self-employment piece that as much as you can, because that piece is going to be the tax-free component. If all of your funds were used for payroll, then there's not much you can do about it. But if a piece of it was used for kind of the replacement income for a business owner, then you want to maximize that piece of it, because that's going to be the tax-free piece.
Good. What's the deadline for applying for that self-replacement income?
Well, it's the same PPP loan, whatever your PPP loan forgiveness was. So that's all being kind of administered by your bank. So if someone applied for a PPP loan back in April, they should have been receiving correspondence from their bank about the PPP loan forgiveness process. I don't off the top of my head I forget what the exact end date is. If it's 10 months after you receive it, after you receive the PPP loan, something along those lines. But the bank should be kind of letting the business owners know kind of when that loan forgiveness application is going to be due.
Okay, that's great. I think we're all set on questions. Any final comments, Tony, Brian, before I wrap it up?
No, I appreciate everyone's time. You have our contact information here, and yeah, anything that we could, feel free to reach out with any questions that you have, any ways that we could help. But like I said, this whole program's designed to provide you with information, and hopefully you were able to take away something that you'll be able to use for your business. So that was our goal. Hopefully we could do more of these in the future.
Okay, that's great. Brian and Tony, thank you very much. As a reminder, recording this webinar and the materials are available within a couple of days on our website at fairfieldcounty.score.org. Please check our website for information on upcoming webinars. Speaking of which, our next webinar will be tomorrow at noon again, when Budley Freund will present practical technology tips to keep your small business running efficiently and safely. You can register for this webinar on our website. Again, that's fairfieldcounty.score.org. And just a reminder, SCORE offers free individual counseling. So please use the link on the screen or visit our website and click Request a Mentor. And we'd be more than happy to help you either start a business, manage a business, any questions you may have. We'd love to help you with that. And as a reminder, it is free. So on behalf of Brian, on behalf of SCORE, thank you, Brian, as well as Tony for presenting today. And thank you all for attending today's webinar. Have a nice rest of the day, everyone, and stay healthy.